Let's start the hour in East Africa, specifically in Kenya, where fuel prices have crossed the 200 shilling mark for the first time ever, following a review of the country's fuel prices by the Energy and Petroleum Regulatory Authority. Now, that increase has caused a lot of concern among citizens and enterprises, and it comes at a time when Kenyans are already struggling to cope with the cost of living crisis. With the details, here's CGTN's Najma Abdurizak.
The Energy and Petroleum Regulatory Authority announced the decision to hike fuel prices on Thursday night in a move that it said was in response to the surge in global crude oil prices, which have reached unprecedented levels in recent weeks. While making that decision, EPRA also clarified that the new fuel prices include a 16% value-added tax, which was effected back in July, following the assenting into law of the controversial Financial Bill of 2023, currently the Finance Act of 2023. In response to EPRA's latest review, the price of super petrol has gone up by 9% and is now retailing at around 211 Kenyan shillings, equivalent to $1.44 a litre, which is a record for the country. Diesel, mostly used in public transport, also went up 12% to $1.36 in a surge that has generated a lot of anger and worry among Kenyans.
We feel so bad as motorists. Everything is increasing. Not only the fuel, it's not affordable anymore. We prefer even to park our cars at home and come to work. Yeah, because if you fuel like now, I want to fuel for 1,000. If I go to Kileleshwa and I come back, my tank is empty. So it's not bearable.
If it comes to tell a customer to add you something on top, others, they tend even to report you back. They rate you badly, that a rider overcharged. So what we always try to do, like for instance on my side, I always extend the working hours. If you used to work from morning maybe to 8 p.m., so you need to extend up to 12 or 1 p.m. so that we can get something.
And this morning we woke up to the fuel price going up to 211. And I work with Bolt. The Bolt industry, they are not they're not considering the drivers what we're going through. Because if the price go up, they need to consider and add the fare for us. And unfortunately, so far the prices are still the same.
It's an additional strain on the already stretched budgets of ordinary Kenyans, marred by new taxes and high inflation, which was just starting to ease, with the latest government data for August showing that the rate dropped for the first time to within the central bank band to 6.7% from 7.3% a month before. But that progress could be in vain, with the latest fuel hike expected to go beyond the immediate impact on citizens and have a cascading effect on the overall economy. Businesses are set to face higher transportation costs, which could translate to increased prices. Najma Abdurizak, CGTN, Nairobi.
Now, still in Kenya, the Finance Ministry has unveiled a raft of tax policy proposals, which it says are intended to reverse a multi-year decline in tax revenues as a percentage of GDP. Now, among other things, these proposals include cutting the top level of corporate income tax down from its current level of 30% down to 25%. The Finance Ministry would also like to reintroduce a minimum tax, but earlier efforts to impose that back in 2021 was struck down by Kenya's courts and declared unconstitutional in September of that year. Value-added tax rate, which is currently at around 16%, would also be reviewed, but the Finance Ministry did not explicitly state if that meant raising it to 18% to bring it in line with other economies in the East African community. All right, then let's dive into the details of these tax proposals and the state of business in East Africa's largest economy. Habil Olaka is the president of the Federation of Kenyan Employers. He's joining me live on the program tonight. Thank you very much for your time this evening.
Thank you.
Okay, so let's start with a broad picture here, right? We've just started implementing a whole host of new taxes, new income tax rates that have essentially come into effect, among other things, revisions to excise duty and so on and so forth. From the perspective of employers, how do you cope with these new costs?
Yeah, I think from the perspective of employers, I think one is that all these taxes coming into play, they have got an impact on cost of doing business. So what employers are seeing is that each proposed measure somehow hits their expense lines. A number of them are directly affecting their payrolls. So when you get a tax like, for example, the affordable housing levy, which the employee suffers, but also the employer is meant to match, it directly hits your cost base. Things like, for example, the VAT on fuel. It affects almost all your expense lines because not only is it affecting the transport cost, but it also affecting other, expense line items. So the general idea or the general thing that is coming out of it is the fact that the cost of doing business is going up.
So are members responding by freezing employment, or has it gotten to a point where employers are saying, you know what, this between what we're seeing now and what we're seeing in the future, because this proposal from Treasury includes things like a carbon tax, revisions on fuel prices, the VAT rate might go up, so we're now looking perhaps at VAT at 18% on fuel instead of 16%. Looking at all of these in aggregate, are your members saying, you know what, let's start implementing a range of pay cuts and layoffs?
I think what tends to happen is that when costs are going up, you start rationalizing the cost, and you start looking at your cost base and trying to see where can you either cut or rationalize or reduce for that matter. Now, if you look at a normal cost base for a company, the biggest item normally will be employment cost. And that's where you normally focus, because that's where you can have the biggest impact. So you'll start seeing employers beginning to either propose voluntary early retirement schemes, some of them being forced to actually retrench staff, declaring them redundant, or even having pay cuts, because that's normally a much more difficult thing to achieve. But that's now conversion is going to start occurring. And you're seeing it already happening. A number of companies have actually already closed. And also the other thing is you'll see most companies becoming informal. And informality has been our biggest problem in terms of achieving economic growth, because when entities are operating informally, things like tax compliance is not possible to track. And so the few who are formal are the ones who are going to be suffering the tax. And so the approach will be that increase the tax rate on the few who are actually complying.
Which is basically what's happening.
Which is what's happening, yes.
All right, then. So actually, now that you mentioned that, this draft medium-term revenue strategy from the Finance Ministry, I mean, it's a fairly lengthy document. There's a whole host of proposals in there, like, for example, a proposal to level the playing field on pensions, for example. So contributions are exempt, but withdrawals on the tail end, unless you're over the age of 65, you're not tax exempt. They're going to be hit with the same, essentially you're going to be taxed by government. But they're proposing to essentially make the entire chain exempt. Are there proposals in here that actually make sense to FKE, or is it generally a business, a very hostile policy document?
I think if you look at the rationale, the objectives of the whole policy document, I think it's positive. Because if you look at the rationale, was the fact that our tax revenue as a proportion of GDP has been going down. Right now, I think we're at about 13.5, and the proposal is to increase it from 13.5 to 20%. Now, that in itself is good, because in Kenya, one of the biggest challenges we have is that the proportion of productive people who are actually paying tax is very small. And if you can increase the tax base and lower the actual tax paid by the individual, which is the objective of the policy, I think from that perspective is good. Now, I think the biggest challenge is the fact that, and also the other thing is the fact that I could see some proposals in there about trying to walk the path of greening the economy. So things like introducing the carbon tax and taxing coal and all that.
That's going to be deeply problematic, though, introducing a carbon tax at this point.
Yes, that's what I was saying, that the overall intention is good. I think the biggest problem is going to be on the specific on how to implement it, because some of them are actually going to increase the tax rates or the tax on the individual rather than reducing the tax on the individual as the overall objective was meant to be. So in terms of implementation, it may not be quite what the policy is proposing, that you are going to increase the tax base and reduce the actual tax on the individual.
So essentially this, in the round, by the time we're done, because considering all the factors that we're talking about now, the Kenyan shilling, for example, down 20% against the American dollar so far this year. We know that if you compare inflation-adjusted income, 2017 to 2022, in that 5-year period, people were making a lot less last year than they were in 2017. So essentially, we're trying to squeeze more money out of a much, much smaller pot. In balance, this doesn't seem to be the sort of strategy that you'd adopt to try and prop up growth. Shouldn't we be going in the other direction and cutting taxes?
I think one of the things, if you look at it in terms of the government being able to fund its development program, I think it's necessary for them to raise the necessary revenues based on the size of the economy. So the approach of trying to increase it from 13.5 where we are today to 20% is good. However, the problem is that if you're going to achieve that by taxing people more, even though that's not the intention, it will be counterproductive. You see, now what they need to ensure, and some of the things they're proposing, for example, the exemptions to tax. And there are quite a number. Some of them not deserved. No, they need to be rationalized and removed completely. Some of them, like for example, there are areas which are not being taxed on a level playing field. I think those are the ones that needs to be rationalized so that you bring everybody who is not paying tax up to the same level with everybody. Now, if you're able to raise your revenues up to 20% by taxing, by increasing the tax base to a wider one, you will actually be able to achieve the individual tax paid by the individuals much lower than we are today.